Welcome to Founders Friday. This is a tell-all for everyone that is interested in how do we produce revenue as startups and as scale businesses. Our theme for today is product-led growth, which is pretty consistent with what we've shared with you in the last few episodes. But today's episode is a little bit different. This is the first in a series of conversations with a VC that invests in PLG companies. My guest today is Blake Bartlett, investment partner at OpenView Partners. Blake joined OpenView in 2013 and literally coined the term PLG in 2016 as he was scanning the software landscape. He's one of the first in the industry to identify the PLG trend and then invest in it. He has invested in companies like Highspot, Calendly, and Expensify, among others. Blake, thanks for joining the Founders Friday series today.
It's great to be here. Thanks for inviting me.
Of course. So we want to dig in a little bit deep into PLG with you and take our audience through the entire journey of what building a PLG business looks like. And it's literally redefining the way SaaS companies operate today. So we would love to get your perspective on that. Our goal is to educate and entertain. So be yourself, have some fun with it, and we'll see where the conversation leads.
Perfect. Sounds good to me.
So let's start off by having the audience get to know you a little bit better beyond the professional part of the side of you that I just shared with them. So tell us a little bit about yourself. Tell us who Blake is.
Yeah, so outside of the professional aspects, I'm originally from Southern California, so I grew up in San Diego. Although I will say that I am one of the few people, the first question I get is, so you're a surfer, right? And I said, nope, I hate surfing. I don't surf. So I'm one of the few San Diegans who does not step foot on a surfboard. But I did grow up there. It was a wonderful place, always sunny, never rains, so can't complain about that. And then went to school in LA and lived in LA for a few years after that. So it was kind of always Southern California for me. And despite not stepping foot on a surfboard, I definitely did grow up on other types of boards that you would expect in Southern California, skateboarding, snowboarding, all of those types of things. So very much a through and through Southern California guy. But then in 2009, I had the opportunity to leave Southern California, go someplace else. I made it out to Boston when I originally joined Battery Ventures. And then thought that I would do a short little stint on the East Coast. At least that's what I promised my family and friends, 2 to 3 years. It turned into 11 years that I lived on the East Coast and lived in Boston. Fell in love with Boston, loved it, spent about 4 or 5 years at Battery, and then since then have been at OpenView in 2013 when I joined the firm. I have now made it back to LA, so I am based in Los Angeles again, back to the home of Southern California, which was a move my wife and I did just about a year ago. So that's some high-level, non-professional things about myself.
Awesome. So does this mean you're going to get back or get into surfing this time around in your Southern California?
We'll see.
Might happen.
We'll see. Maybe if the water gets warmer. That's always been my complaint. If it wasn't so early in the morning and if the water wasn't so cold. So I think those are perennial features of surfing. So I'll probably stay out of the water.
Okay. So you mentioned you were at Battery before you went over to OpenView, and of course you've been there for a long time. Tell us a bit about what brought you into investing. Has it always been something what you've been doing, or did you start somewhere else and then move into venture capital?
Yeah, so it has been what I've always been doing as a professional career, but the way that I got into it was in undergraduate, I studied business, and I thought I was going to go down one of the more common paths that many go down. I was looking at investment banking, but didn't really want to do finance, and then was looking at consulting and really liked consulting because it allowed you to look at businesses. In school, I was doing these, HBS case studies and things like that as an undergraduate. And I like looking at the totality of a business, what's going on in the market, who are the competitors, how do you differentiate against those competitors? What are the supplier problems you're having? What are the customer demand problems you're having? And you look at the totality of it and then identify sort of what should be the recommended solution for business problems given that totality of the context. So it's not just thinking about marketing. It's not just thinking about accounting. It's thinking about, really the all aspects of business strategy. And I love that holistic view of things. But I never made it to consulting because a really good friend of mine was working at a private equity firm in LA and was really building out their direct sourcing team. And so this is a team of individuals that basically every venture firm and private equity firm has now that acts as the sales force for these venture funds to cold call CEOs, to identify opportunities and those types of things. And then what you do on these calls is ultimately in 30 to 60 minutes, try to assess the market, the competitive landscape, the team, the product, the differentiation, the trajectory as well, and then make a decision. Is this one that we should continue pursuing? Is this one that we should pass on and not pursue any further? But you're basically doing that exercise that I mentioned of looking holistically at a business and a market and then making a decision about what to do with it. In our case, it was a pipeline decision of do we accelerate this opportunity forward or not, but it still had a lot of those similarities that I had really appreciated about consulting in terms of holistic thinking about business strategy. So that's kind of what got me into investing. It was actually through this consulting angle that led to sort of the sourcing angle, which is kind of a sales role. And then I've been in in investing my entire career. And so I've been able to build on it and develop those sourcing skills and then develop deal evaluation skills and due diligence skills. And then ultimately get to a point where, I'm a partner writing checks, taking board seats and learning how to support companies operationally. So it's really been the kind of, the cradle to grave experience, so to speak, growing up as a VC.
Very cool. I think it's just fascinating to hear all the different aspects of the business that you have to get involved with, whether you're in consulting or in a venture role. So tell me a little bit, you probably get hundreds of inbounds and opportunities to sort of look at different businesses over the course of a year. And, it's probably a handful or a couple that you actually invest in. What are some of the criteria that you look for? What are some of the parameters that get you excited and sort of get you to commit to making an investment?
Yeah, well, look, there's things that every VC looks at. Everybody wants to know how big is the market? What are the market dynamics in that segment right now that's driving a catalyst? What's the value prop and how strong is that value prop or the ROI of the solution? The team and how uniquely suited they are for that market. So we look at those factors as anyone else would. And then OpenView has, particular strategy. There's a stage of company development that we get involved in. So we kind of look at a specific lens. But take those things aside, kind of for me personally, Blake, as a VC, what am I looking for? Really, it starts with product. And I really love to understand, first and foremost, why this product. What was so painful about this problem that you either experienced before as somebody that was needed to use legacy solutions, or as somebody that perhaps worked at one of the legacy vendors that caused you to want to dedicate perhaps the next decade of your life, or perhaps, the rest of your career to building this. Let's really get into that problem and then understand the solution of how you've diagnosed the way to solve that problem. So it's always first principles from a product standpoint. And then really looking for things that are standing out and differentiating in terms of a product approach versus just, this space is big and, we think we can have a easy to use solution in this space, kind of more commonplace things, really looking for things that spike above and say, wow, I haven't really heard somebody describe it that way or take that approach before. Expensify was a great example, and we can get into that example and others, which was the key insight for them. And that's kind of the thing. YC calls it a key insight or a unique insight, was really flipping the equation on its head, recognizing that expense management might not be the most exciting category in the world, but it's a big category. Every business has expenses. Those expenses need to be managed. If employees need to be reimbursed, that has to happen and it has to be accurate. But it had always been targeted at the CFO and viewed as a CFO problem. Give the CFO all the knobs and dials to be able to lock down T&E and to manage expenses. But Expensify comes along and says, that's not the problem. The problem is the submitters of expense reports, because every company has one CFO, but then everybody else in the organization, if it's a 10,000 person organization, then 9,999 people are submitting expense reports because they're not the CFO. So let's solve that problem. Let's make it easier to submit and really think about it from the end user standpoint. And that was a beautiful tie-in to their tagline, which was expense reports that don't suck, because everybody knows if you've submitted an expense report, it does suck. It's painful. Yes. And so that tagline, immediately spoke to that individual. And so that was kind of their unique insight, flipping the model totally on its head. And so I'm always looking for something like that. Tell me something I haven't heard before. I don't want just another one of those in this category. I want something that's kind of, fundamentally different, has a unique insight that stands out, because those are the things that end up oftentimes having the highest likelihood of disrupting the space and then becoming the winner take all.
Yeah, I completely agree. And I think your key point about having a unique insight and starting with product as the first principles are the ones that definitely resonate with us, as well as we think about what we're doing here with Immersa. But more about you and OVP. So let's maybe shift gears. Tell us a little bit about OpenView Partners, the firm itself, and are there some specific investment areas that you focus on? What's kind of unique about the investing style that OVP brings to the table?
Sure. So OpenView as a firm was started back in 2006. If you fast forward to today, we're investing out of our sixth fund, which is a $450 million fund. And really the key things for OpenView, I mentioned that unique model of what we look for, when we're out there in the world. And, there's a few things. First, from a sector standpoint, if you will, we only invest in B2B software. So it's SaaS and infrastructure. And it's been that way since day one, since, again, 2006. And then we're also pretty specific about the stage that we get involved. We call it the expansion stage, which is really just a fancy term to describe businesses that are post-product market fit. So oftentimes the rounds align to a Series A or a Series B. But we've really found that there's this key spot in a company's development where you have the traditional early stage, which is all about building a product, iterating on the product, getting it out the door, and then getting product market fit within your ICP. Then you start to accelerate. And then there's a later stage, which is the growth stage and the kind of just add water phase. Everything's working, we just need to scale it up. But that middle zone, there's a lot of company building and a lot of professionalization and sort of building repeatability that has to happen when you go from identifying product market fit before you can get to, just scale the thing that's already working. And so that company building phase, that when you hit that inflection point of growth, when the market's starting to pull you, and in some cases pull you faster than you can keep up with, that's the expansion stage. And sometimes it happens at the Series A for companies, sometimes it happens at the Series B for companies. But if we can be at that critical point and focus there as an investor, and then also bring a lot of operational resources to bear, that really in many ways is the make or break point post-product market fit. If you don't put repeatable processes in place, if you don't hire the right team, if the CEO isn't able to go from doing everything in the business to truly leading the business and, kind of the working on the business versus working in the business classic statement, that can, like I said, be the make or break moment of, will this reach escape velocity, or will this sort of fizzle out under the complexity that every startup faces? And so that's why we focused on this one stage, the expansion stage. We think that it's really valuable. And then we just fundamentally believe in the value of focus at OpenView. VCs are constantly telling their portfolio companies, you need to focus, focus, focus. Yeah. You can't be all things to all people. Pick a lane, do one thing really well as opposed to a million things mediocre. But then venture firms oftentimes turn around and break all of those own rules themselves and try to be all things to all people, invest in every sector, every stage, every geography, you name it. And so we actually try to practice what we preach. And we believe that in addition to this being a critical stage of company development, we also just believe that we will be, at least have the chance of being the best in the world at what we do if we're trying to only do one thing. Yeah. So that's a little bit of our philosophy and focus and approach.
Makes a ton of sense, Blake. And I'm probably going to go in a bit of a controversial direction next. We've seen a lot of shift in the venture industry in the last few years, in particular in that growth stage and the expansion stage where you focus. So we've seen later stage VCs move up in those cycles. We've seen even hedge funds move into those cycles, and it's led to a completely different type of investing and scale of investing. And frankly, valuation. So how do you sort of compete with that? How do you look at that, and what's the point of view that you have around that particular type of investing, and folks that are kind of coming in with a lot of money but not a lot of understanding of the space of the market?
Yeah, well, I think on the one hand, it's very clear why. There already had been this massive wave of digital transformation that had been happening, and then obviously COVID accelerated that dramatically and continues to accelerate it. And for a while also, in the depths of the pandemic, there wasn't really a lot of other places where investors wanted to put their capital in terms of areas of the economy other than technology, because that was the one thing everybody was relying upon so heavily. And so there's obvious reasons why so much investor attention has been attracted to tech companies and startups. I mean, when you see what happened to companies like Zoom overnight, it already was a big successful company, but then it became a global phenomenon. And so investors say, I want to be in the next Zoom because what if this business is the next one to take off and have that hockey stick style growth? So you understand what drives the interest. However, that can also go too far and just become sheer FOMO, where it's this might be the next Zoom, this might be the next Zoom, this might be the next Shopify, and you just are afraid to miss out. And so you start placing bets on everything. And then you start placing bets, okay, a good firm did the Series A. Well, how about I just preempt the Series B the next day? Because I don't want to miss the deal. I don't want to lose the deal. There might not be any progression from when the A was done to when the B was done, but let me just get in now because I don't want to lose to my competitors because there's more money sloshing around in the market. And so it can overcorrect, and it can lead to dynamics that aren't necessarily the most healthy, just pure FOMO driving investment decisions. But I think that's kind of a way to think about it in terms of what investors can do because again, we have competitors, we have folks that we raise capital from, all the dynamics that founders experience operationally, we also see in our industry. And so I think that there are fundamentally two different ways you can play it. One is to sort of join the fight and sort of do what others do. And if one firm's moving faster, you try to move faster. If somebody's, moving in a week, you try to move in 6 days. If somebody's moving in 6 days, you try to move in 3 days. And it eventually gets to, well, there's only so fast you can possibly move. There's only so many things you can cut out of the equation. And so you can kind of try to keep up. The other approach is to really try to focus and say, we're not going to chase everything that comes our direction and be falling all over ourselves for a week sprint after week sprint after week sprint. And instead say, all right, let's take a step back. Let's be a little bit more strategic. We're not going to chase a deal and try to do, it in 24 hours. So how can we pick the industries, or even the companies that today we think will be in our zone 6 months from now, 9 months from now, 12 months from now, build a relationship with them early, understand the market, and get all of our diligence done up front on everything that can be done on the market. And so then when there's the opportunity to preempt or to catalyze, you're not kind of going from a standing start. You're going from, well, we've already done the vast majority of our work. And now it's, if you think about it as a sales cycle, all we're doing now is trying to close, as opposed to simultaneously trying to close and diligence and get all the stars to line within what's really in many ways become a multi-day process, which used to be a multi-week or a multi-month process years ago. And so that's kind of the way that I've processed it and how we've tried to tackle it as a firm.
Awesome. Okay. Yeah. And it's a smart approach, makes sense. And I think your point about FOMO is very relevant. And I think it kind of leads to unnatural sort of states for companies and for founders even. It's a kind of a high pressure situation to resist those types of inbounds. I want to take us back to 2013, your early days at OVP. And obviously, when you started investing, PLG was not necessarily even coined or recognized as a trend. And you were, of course, one of the first and one of the early ones to jump onto that and figure that out. So take us back to that. Like, what happened? How did you sort of tune into this? And then is there a backstory? How did you come up with the term PLG? So take us through that a little bit.
Yeah, so it started by actually making investments into PLG companies before we had the term, and then observing their performance and seeing how different it was, both the performance in terms of the results and what the numbers look like, as well as how they delivered those numbers. They just operated differently. And so, and then we just said, all right, well, let's put a name to what those companies are doing because it seems to be special. But in terms of a little bit more detail on that, which companies am I talking about? So the first one was Datadog. Yeah. Which we invested in 2014, early 2014. And then the second was Expensify, which was about a year later in early 2015 that we actually finalized the investment. And then thereafter, Calendly and a few others came along as well. But as we sort of took a step back and looked at the performance of our portfolio, we saw that those companies, Expensify, Calendly, Datadog, businesses like this, always were head and shoulders above all of the other portfolio companies, both in terms of their growth and how consistently they were growing, even as they got to larger scale, able to sustain that growth. And then they were doing it on a very capital efficient, if not in some cases profitable basis on the bottom line. And that really seemed to kind of violate a fundamental law that at least I had assumed was true about startups, which is that there's a trade-off between growth and profitability. You can either grow really fast, but burn a lot to do it, or you can burn less, but you'll also grow less. but you can't have it both ways. You know, these are fundamentally inversely related. However, we saw that with these companies, they had their cake and they were eating it too, in the sense of growing really fast and having efficient bottom line. And so that's what caused us to say, all right, there's something different about these businesses. What really is going on here? And we saw a few things. I think one, and this was what led to the term we came up with, we saw that anytime there was a growth related or a metrics related goal or challenge in these businesses, the first line of defense and the default answer was always, okay, we want to hit that growth target. What are we going to change in product? We want to hit that growth target. Okay, is there friction in the funnel somewhere that we can remove in order to, you know, increase throughput because we have this self-service flow? You know, or, you know, there's pricing and packaging that's oriented towards our freemium funnel. What if we took this one feature that's behind the paywall and moved it in front of the paywall? Would that increase virality? Or if we move it behind the paywall, will that increase conversion rate? And all of this experimentation, it was a lot more like A/B testing of features than it was, let's go hire 50 sales reps. That was never in the equation. That was never the sort of answer when we were trying to achieve growth related targets with Datadog, Expensify, Calendly. Yep. And so that kind of led us to that initial aha moment of, okay, if anytime a go-to-market question comes up or a goal comes up, they lead with product. These businesses are product-led in relation to their growth. And so that's kind of how we came up with product-led growth. But what we really realized was under the surface, it wasn't just the DNA of how these companies operated, but you could actually just see it in the products themselves and the way that they were adopted. And so we realized that fundamentally, one of the biggest differences was that the customer journey started with self-service. And so individuals, you know, could be an individual contributor who just joined the company a day ago, could be, you know, any other employee at the organization acting as an individual, solving their own technology challenges for their sort of productivity, can go on and adopt one of these solutions like a consumer app. You know, within minutes, they can be up and running and kicking the tires on something like Calendly or Expensify, Datadog, Loom, Zoom, Slack, you know, Dropbox, the list goes on of companies that fit this bill. And so we saw that this self-service journey was really different. And we also saw that it was a product that fundamentally was built for those individual users, as opposed to just the budget holders, executives at the top of the organization. And so that was kind of realizing there was this DNA of leading with product when it came to go-to-market challenges, and then really unpacking that to understand that the customer journey begins with self-service and that the product itself is oriented towards individual users as opposed to executive buyers. That was kind of a lot of the calculus and the dots that we were starting to connect. It didn't happen like this. All of that I mentioned and those light bulbs going off took probably about 6 to 12 months before we said, hey, these are unique portfolio companies, to, hey, this is actually a whole new movement that's happening here.
Very cool. And it's great that, you know, you were able to kind of spot that early. And I think just to kind of recap what I heard, kind of 3 key things that I heard in terms of how you define a PLG business. So number one, it's product led. That's what is driving the business. Second, it's sort of this self-service aspect to it, where you can get up and started very quickly in a consumer-like fashion, even though you're in a B2B setting. And I think third, probably the most fundamental shift here is that it shifts the power from, you know, sort of executive level top-down buying to the user making the decisions and saying, this is what works best for me. And so would you add anything else to that? Like, I mean, those kind of 3 characteristics are pretty self-explanatory, but anything else that you'd add to what constitutes a true PLG business? Or what are some of the elements that drive or define growth for these businesses?
Those are the key elements. And I think it's important to focus on those elements, because product-led growth doesn't mean you think you have a good product. Yeah. Because a lot of times I see this misconception. It's like, well, we have a good product. Our product is better than our competitors. We invest a lot in our product, so therefore we're product-led, right? No, we're talking about something very specific in terms of the customer journey. It's not sort of something where PLG is in the eye of the beholder. There actually is a way to do this. And the other thing that I can see as a misconception is sometimes it's, okay, well, we want to do some of that PLG stuff. Let's go hire a growth team. Okay, we got a growth team, now we're PLG, right? And no, I think those are sort of window dressing elements as opposed to truly the definitional piece of it. And I think a litmus test that I often point to is, what does it take if somebody just hears about your product today? What does it take actually map out the process of how they can get started on your product. If they have to talk to humans, or if humans have to get involved in the background in order to provision an account or help implement the account or send a contract or negotiate legal or determine pricing, like all of those things that typically have happened historically in software, if people have to get involved from your team for any of those steps, it's kind of not product led. If it's, again, more consumer like, where any one of us can go and adopt Instagram right now, or Uber, or whatever the consumer app of your choice is, you're not talking to a sales rep at Instagram to buy the product. You're not getting onboarded to Uber from a CSM. You know, the list goes on of things that you wouldn't tolerate as a consumer. Why do we expect that end users are going to tolerate them as business professionals? I really think of, in this day and age, because of how many software choices we have as professionals, you know, it's more akin to call end users in the enterprise, they're just consumers at work. Right. And so you need to think about going after consumers as opposed to going after businesses. And yes, this power dynamic has very much changed.
Great. And so, you know, I mean, I always kind of think about over this past couple of years, as the pandemic has you know, shifted things for a lot of the ways that we work and operate. You know, if every person that signed up to Zoom, my dad, 86 years old included, it had to talk to a sales rep at Zoom, would we have seen the kind of astronomical growth that they saw this past couple of years? So I think that's kind of the point that I hear you make. Now let me shift gears a little bit about, you know, there's a whole movement around PLG now, and we hear that, and it's sort of become mainstream vocabulary. But there's a entire, like 90% or 95% of the B2B SaaS space was not founded on PLG. And so what's in it for those companies? You know, are there elements of this approach that you can adapt or adopt as your, you know, a traditional B2B SaaS software company, and some of the big tech companies that are out there selling the historical traditional way in SaaS? What do they do? How do they deal with this whole PLG phenomenon?
Yeah, so if you think about what PLG is, ultimately you want to get to that point of anybody can show up. They can, you know, start using your product within a couple of clicks and a couple of minutes. Friction is removed, and they can be on their journey to get to the aha moment and experience the point of value in your product. That's where you want to get to. Now, if you're starting from a point of more of a traditional existing SaaS business that doesn't have those things in place, you know, that's not an overnight transition. It is a longer transition. And so, you know, full disclosure, it is not easy and it takes a while. So if you want to embark upon this, there are steps you can take along the way. And I oftentimes I see that instead of trying to take an entirety of a legacy product that has a lot of customers, a lot of dependencies, and try to make it PLG overnight, instead, how can we look at things that are ancillary, that aren't our core product today, and let's start PLG there. That one, will learn how to do PLG as an organization, and two, it's also just a little bit more of a reasonable size of something to bite off, as opposed to our entire product and trying to transform that. Mm-hmm. So that could entail, you know, a new product, for example. If you're looking to add something new to your product portfolio, well, start that new thing as a PLG product, as opposed to starting it in the way that you've always built product. Or if there are certain features of your current existing product that you can sort of hive off almost and make those individual sort of features self-service, that then can be an on-ramp or a stepping stone to the broader adoption, that can be sort of a good way to get there. So what's an example? HubSpot is a perfect example of this. They have made the full product-led growth transition. And it's also impressive for them because they created the concept of inbound. I mean, their conference is still called Inbound. If you want to refer to their style of growth that they pioneered as marketing-led growth as opposed to product-led growth, they are the ones that really put that on the map. And so to see them make a transition from the thing they created to now the next phase of product-led, it's really impressive. And they did it at scale. So the way they did it was focusing on a new product, like I had referenced, and it was their sales product. And so when it began, they kind of created a startup within a startup, you know, put like 3 or 4 people in a room and said, you know, do whatever you think makes the most sense for this product. Don't do it in the HubSpot way. Do it in the right way for this audience. Do it from first principles and see what you come up with. And what they started with was a product for an individual AE or an SDR, and it was very, very basic and very, very tactical. It was email open signals, which is now a commodity feature that exists in basically everything that touches email for sales reps. But to see that moment, did somebody open my email? They opened it right now. They forwarded it to their colleague. They've opened it 5 times in the last 24 hours. Those signals are incredibly valuable. I should call right now. Mm-hmm. That was all the product did, email open tracking. But that was, at the time that they launched it, a novel feature, a new feature, and incredibly valuable. And so they were able to let that take off like wildfire. And then they added more workflows to it. It became sort of an SDR workflow tool. And then fast forward to today, they've continued to fuel the success, and they have a full-fledged CRM that you can adopt in a product-led way through these different tools and technologies that sort of lead you along the way to the full CRM adoption. And then they've transformed Marketing Hub and Support Hub and all of the other hubs that they have. They have now transitioned those to product-led as well. But again, it started with a new product. It started with something that felt incredibly tactical. Like, this is definitely not a business. This is just a feature of a feature of a feature. But that was the perfect place. And so start small. And in some cases, start extremely small, because you can build a lot from that starting point.
Awesome. Great. So Blake, I'm going to just recap the part 1 of our conversation here for our audience, and then we'll pause and shift to the second part of the conversation. So, we covered who Blake is. We covered, how you kind of came across this whole notion of PLG with your first couple of investments at OpenView Partners, and led to kind of coining a term that's now become a movement. I think the definition that you kind of put in place with what you think of as a PLG business, which is lead with product, shift the value to the end user, let them make the call on what they're going to go use, and then the user journey and that experience has to be self-service. Really neatly sums up the way that you think about it. And it's not just for new companies that are forming now, but existing companies have an opportunity with the HubSpot example that you just shared to move in that direction as well. So we're going to take a pause here. We're going to thank you for so much of the insight and the knowledge that you shared with us. I want to come back again next week and pick up phase 2 of this conversation that will lead into a different direction.